Are revenues debit or credit? One of the most common questions for accounting students, business owners, and anyone learning bookkeeping is whether revenues are recorded as debits or credits. Understanding the answer requires a basic knowledge of the accounting system and how financial transactions are recorded. In accounting, every transaction is recorded using the double-entry bookkeeping system. This system requires that each transaction affects at least two accounts and that total debits always equal total credits. While this may sound complicated at first, it helps ensure that a company's financial records remain accurate and balanced. Revenue represents the income a business earns from its normal operations. This can include money earned from selling products, providing services, subscription fees, consulting work, and other business activities. Revenue is one of the most important figures on a company's income statement because it shows how much money the business generates before expenses are deducted. The simple answer is that revenues normally have a credit balance. When a business earns revenue, the revenue account is increased with a credit entry. This is because revenue increases the owner's equity in the business. In accounting, increases to equity accounts are generally recorded as credits, while decreases are recorded as debits. For example, imagine a company provides consulting services and receives $1,000 in cash from a client. The accounting entry would look like this: debit, cash $1,000. Credit, revenue $1,000. In this transaction, the cash account increases because the business received money. Since assets increase with debits, cash is debited. Revenue also increases, and because revenue accounts increase with credits, the revenue account receives a credit entry. Things can become slightly more complicated when customers purchase goods or services on credit. Suppose a business completes a project worth $2,000 but will be paid later. The entry would be: debit, accounts receivable $2,000. Credit, revenue $2,000. Here, the company has not yet received cash, but it has earned revenue. Accounts receivable increases with a debit because it is an asset, while revenue still increases with a credit. Many beginners become confused because they associate credits with negative amounts and debits with positive amounts. In accounting, debits and credits do not automatically mean good or bad, positive or negative. They simply indicate the direction of a transaction within specific account categories. A useful rule to remember is the accounting equation. Assets equals liabilities plus owner's equity. Revenue ultimately increases owner's equity because profitable operations add value to the business. Since equity increases with credits, revenue accounts naturally carry credit balances. On financial statements, revenues appear near the top of the income statement. Businesses track revenue carefully because it provides insight into sales performance, growth trends, and overall profitability. Investors, lenders, and managers often analyze revenue figures to evaluate the health of a company. There are situations where revenue accounts may temporarily show debit entries. For example, sales returns, discounts, or allowances are often recorded in contra-revenue accounts, which carry debit balances. These accounts reduce total revenue reported on the income statement. However, the primary revenue account itself normally maintains a credit balance. In conclusion, revenues are generally recorded as credits in accounting. Whenever a business earns income from its operations, the revenue account is credited. Understanding this fundamental principle is essential for accurate bookkeeping, financial reporting, and mastering the basics of accounting.